Good evening, folks. Welcome to TopGunStockTrading.com. This video is for Tuesday, 21 January 2014. Pretty good day for the market. We had a large gap up, large opening price, and only to see it sell throughout the morning, and the volume subsides, and then the light volume float for the rest of the day. So basically, this is institutional distribution at its best, and you can see it right here in the charts. I'm looking at the 10-minute tick chart here just to further illustrate what I'm talking about. You see all the volume in the morning come in 7:30. That's Mountain Time. Comes in. That's when the market opens 7:30, 9:30 Eastern Time. It comes in. Volume comes in, and the institutional is selling into the little guy. So what happens in the pre-market hours is the pre-market, the futures, a lot less volume. Takes a lot less money for these institutions to bid up this market, get the little guy into it, thinking it's going to continue going up, and then they just rip it, pull out the rug out from underneath them, and start the selling. So they sell from 9:30 in the morning. Again, that's market open until about noon Eastern Time, and then you see the volume down here kind of whittles away and kind of goes out to nothing, and that's where you get your light volume float into the end of the day, and at the end there's a little bit of buying, probably some short covering there at the end. So that's how the institutions are basically selling into the fervor of the retail investor. So a couple things I noted, been out on the news. I've seen a couple reports and charts this weekend as I'm doing my homework, trying to find the next trade there. Margin is at the greatest since 2007. So what's margin, and who uses it? Well, margin is basically you borrow from your broker to buy a stock. You don't have the money yourself, but you have, say you have $25,000 in your account. If they give you 3-to-1 margin, basically you have $75,000 buying power. So that's basically margin. So you're buying on margin. It's basically taking out a loan to buy stocks. And of course, they charge you an interest rate and a fee and all that stuff. But what happens when the stock that you're buying goes down a certain amount or a certain percentage, the bank or the brokerage gets fearful and goes, hey, you know what, your stock's down a lot. I'm going to have a margin call. In other words, I'm going to need some of that money back just to ensure that I'm going to get my money. So the margin calls for selling, and then selling produces lower prices, which produces more margin calls. So it's a vicious cycle if you get into that. And right now we are at the highest margin since 2007. Oh, by the way, that was the last large market correction, and the largest before that was 2000, which, by the way, the tech bubble of 2000. So the signs, writings on the wall. And who uses margin? Institutions don't use margin. They have their own cash. Heck, they make money every day. It's a little guy that's borrowing. Secondly, we're experiencing the largest mutual fund inflows ever. So who's buying mutual funds? Not the institutions, not the hedge funds. The little guy is buying mutual funds. So we know that the retail investor, the little guy, is buying hand over fist these stocks at the top of the market, also borrowing money to buy, yet we still have these down selling pressure. So what's that tell you? That somebody is obviously selling more than the little guy can buy. Okay, that's why you get the price action to the downside, right? Price goes down because there's more supply than there is demand. Albeit there's a lot of demand, there's even more supply. And who has a large amounts of supply is these institutions. So this is what they call distribution. And what happens at the end of when the music stops is the little guy is stuck holding the bag at the top of the market, and it comes crashing down, and the little guy loses all of his money. Meanwhile, the institutions are banking money hand over fist, shorting the market. So, like I said in one of my articles, the largest transfer of wealth in the world is the stock market. So it's up to you to educate yourself so you don't become one of those guys the next time around when this market comes crashing down. And I think that's going to be soon. All right, let's move on. IBM. IBM just reported earnings after the bell, and earnings has been not too good this week and last week. So taking a look at IBM after hours, 182.65. It was closed at 188.43, so it's down $6. That's about 3% after hours. So that's telling you that the Dow Jones, the market's going to open tomorrow down significantly, since the Dow Jones is price cap weighted and not market cap weighted, like the S&P is market cap weighted. So price cap, that means the bigger stocks are going to have more of an effect on the overall Dow Jones Industrial Average. So there's 30 stocks in the Dow Jones, and the price cap weighted. So $180 stock going down 3% is going to have a pretty significant impact on the overall average. So what's that mean? It doesn't really mean anything. That's one of the reasons why I follow the S&P and not the Dow Jones, because the S&P is market cap weighted, meaning the market cap of the individual stocks as a percentage of the overall price movement in the S&P. IBM reported not so good earnings. They're down 3% after hours. JP Morgan, some of the market leaders here, down a little bit, up 6 cents on the day. So what's that tell you? The market's up 54 cents, or whatever percentage that 54 cents is, which is larger than what JP Morgan was. So JP Morgan is basically a market leader and shows you what exactly gives you an overall trend or direction in the markets. JP Morgan's only at 0.1%. The market's at 0.3%. So relative weakness in JP Morgan. Looking at the tech sector, basically led this market today. Amazon up 7.44 points, 1.86%. Strong move by Amazon, a strong stock. It intraday hit an all-time high, 407.80, and it looks like a new all-time closing high of 407.05. So it's a strong stock, tough stock to short, but in my opinion, even at these tops, it's showing a tough time to get through this. This seems to be a wall here at about 406, 405, 406. So what happens when you keep beating on a wall? Or you get tired, and eventually you just kind of take a break. And I think Amazon's up for taking a break here pretty soon. We got a 3-bar surge, not necessarily a surge, but 3 up days in a row, with the third one being a pretty strong day with probably slightly above average market volume. One thing to note here on Amazon is the divergence that we have in Amazon. And by divergence, I mean as the price of the stock moves up. If you look down here at the MACD, which is down here at the bottom of my scope. And again, I don't use MACD all that often, and it's a backwards looking indication. You can see when the price action of the stock goes up, left to right, and the MACD is going down. That is called bearish divergence. That means the institutions are distributing Amazon at these levels. Now that doesn't give you a tell on when exactly Amazon's going down, because as you can see, it's had some bearish divergence for the last month and a half, 2 months, as you can see, and is still continuing on, slowly edging higher. It's only up 10% though. So not only, but it is up 10%, so it can still go up. Doesn't mean it's going to go down. But you can tell that I think Amazon's in its final stage, or in the end game of where it's going to get a pretty hard selling pressure. It's going to come into this stock pretty soon. MACD is moving average convergence, divergence. I can explain that on another video, or you can just Google it or look up Investopedia, and it gives you a pretty good explanation of what the MACD will tell you. But I don't use all this other stuff, all these other indications, except when the stock's at its all-time high or all-time low, and I see what's going on with the institutionals. Apple had a pretty good day today. It was up over almost 8.5 points, and as you can see, it came into some support on Friday, and got a pretty good bid today. I don't think there's anything to play on this stock. No pattern. I don't have any support or resistance lines, so I don't really have anything. I don't think it's a trade for me on Apple. Just watch it and see if it makes a pattern and maybe give us a trade setup. Same thing with Google. Google hit all-time highs today. Like Amazon, 1164 closed at just shy of that. That's probably got some more upside. Pretty strong stock, again, above all the moving averages and uptrend. So I wouldn't touch Google either. Boeing, I am in Boeing. I am short. Boeing went up 0.121 on slightly lighter volume, so it's just kind of hanging out in the upper edges here of its all-time highs. Again, I think the risk to Boeing is to the downside here, so I'm feeling pretty confident in that Boeing short. Likewise with Bank of America. Bank of America was even Steven on the day, even with the market up 0.3% or 0.4%, whatever it was. Bank of America could eke out a gain. So again, this is at the all-time highs. I think the risk to Bank of America at these levels is to the downside, and that's why I'm short this Bank of America. Yahoo, I'm always also short. I've been short for probably about a week or two now. Definitely in the money here. It was weaker earlier in the day, low of 38.86, and it came back 60 some odd cents there. So to close down, still 49 cents. So I think Yahoo goes down even lower, and I think it'll probably find some support around the 35 level, right around this area where you had the prior peak right here, and then a support level. So around $35 is where I'm looking to get out of Yahoo. Dry ships, I stopped out today, break even. So I thought maybe it could run up, but it did run up and then it came back down. So I set my stop at break even to include my commission, and that's what my technique is. I'll put it once the stock runs for me. If it runs far enough, I'll take half off and set a break even stop. Otherwise, I'll just set the break even stop to include my commission fees, so I don't lose any money on it. So it's basically a free trade. That sometimes doesn't work out for you. So sometimes you stop out, and that's the key to trading, is to take small losses or even Steven there. The only people that make money in those cases is going to be your broker. JCPenney to me is getting interesting. It is down in the dumps here, and usually when stocks are hated is when I start to get interested in them, because that means they're about to make a turn, right? We talked about the emotion, when the hype, all the hype is at the top of these markets, try to get the little guy in, and then they sell right into them. Well, the opposite's true as well at the bottom. So when a stock is the most hated stock on Wall Street, and the media is very negative against it, it's usually a sign that it's about time to get in this stock. So today it went as low as $6.30. So it is basically in spirit of double bottom there. I'm going to look a little lower myself. I'm going to look at a lower with a better pattern, and I want some more volume, some capitulation volume in this. So I'm not a buyer at these levels. I will wait lower on JCPenney's. All right, folks, it looks like it's about all I have today. Taking back a look at the SPY, the wrap up here real quick. Again, up 55 cents. Another distribution day, mind you, so don't be bamboozled into thinking that the all is good and well with the stock market. In my eyes, we're just setting up for a larger move down. This week, looking for weakness. And I'm probably going to find some weakness Tuesday, Wednesday, and Thursday. Friday, usually a low volume, light volume float up. So if we're going to get this weakness, it's going to be tomorrow, Wednesday, and Thursday. So that's what I'm looking for. All right, until next time, I'll see you on the charts. Have a good evening, folks.